battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 44 years, it's been the Stenger family's mission to deliver you both clarity and confidence to help secure your financial future. Yes, we are back at it. Let not your heart be troubled. We took a few weeks off here to get ready for Investor Day. Had an awesome event up here in Oak Brook. Just an absolutely tremendous deck of speakers. We've got some replays coming out. Had some of our top clients out as well, and it was just such an enjoyable event. If you attended that, thank you for being with us. And if you didn't get a chance to come up to Investor Day this year, you don't want to miss it next year. It's just such a different experience being there in person and getting to interact with everybody, getting to talk to the speakers, getting to see other clients, and just having such a great event. So make sure that you come up next year for Investor Day. It's probably going to be September, October. We're looking at some dates right now. We've got a really important special guest that we are going to announce for Investor Day next year, hopefully soon. Can't say the name yet, but it's a big name in the investment industry. So just plan on keeping some of your weekends, if you can, open in September and October next year, and we will send the save the date out as soon as we have the guest speaker lined up. And next week, we are going to be in Houston. We're going to be at Mastro's, and we're going to have about 75 of our clients out with us at Mastro's. We're actually oversold on that event, and so that thing is completely full. That's why I keep telling you, if you watch the show, you find out about these events before anybody else. So make sure you like, share it, subscribe to it on YouTube, Apple, and Spotify. You're going to hear about all these events that are coming up before anybody else. I'll be coming down with Sam Hardy on our team, and Chris Jordan, our head of tax, and Audrey Feld-Posh, who's a CFP with us, and a bunch of our other team members will be there. So just make sure you listen to the show. That's how we tell you about these events ahead of time. And those two events, Investor Day last week and then next week at Masters, are going to wrap up our event season in 2025. So we won't have anything now until 2026. So here we are back for episode 204, and it is called Fugazi Wazi. I just want to say, I don't want to brag, but the S&P did hit our target, 6,700, and it's actually a little bit over that 6,700 mark. We hit 67.50 at the high end. I think today we're right around 67.35. And so all of the doom and gloomers, remember, who changed their tune, that said the market was going to come crashing down during tariffs and Liberation Day, whatever you want to call it, April 7th of this year, cut their targets. They were all bulled up for 2025. A lot of them said 6,400, 6,500. We were at 6,700. So we were all basically in the same zone. I'm talking the biggest banks on Wall Street. Just remember, they cut their targets. They told you to panic and sell during tariffs in April. We did not do that at Stenger Family Office. So why is it so important that you get the clarity and confidence? Why is it important that you subscribe? Share it with your friends and family, because, again, our mission is to get the good news, the clarity and confidence out to them so they don't panic. And these strategies, these pundits, cost people real money. Let's not forget the fact that we get fired up about this. We get passionate about this and call out the doom and gloomers, not to make fun of them, not to hurt their feelings, but really just to say, stop costing people billions of dollars. Is that so much to ask for? Because if you're a portfolio manager, an equity portfolio manager in particular, like we are at Stenger Family Office, like a lot of these Wall Street firms have great portfolio managers working for them, they've been steadfast in their belief that U.S. equities will go up over the long run. That's been the right call. So just be careful the type of people you're listening to. If all you do is read the headlines, if you listen to the media, if you listen to the strategists and the people who are bearish on Monday and bullish by Friday on TV, just be careful taking that advice, because it's not really advice. It's speculation. Advice looks like a goals-based plan customized to your individual needs, and then managing that plan over the long run, despite what the markets do. And what the right answer has been for investors has just been to be bullish over time. We pulled the stat at Investor Day. I talked about the fact that since 1985 till today, about 40 years now, market history, the Dow Jones, not even the S&P, but the Dow has actually compounded at 9.3% per year. And that's just the price return. And so we asked the question, well, what would happen if the Dow continued to compound at 9.3% per year? And it turns out that 27 years from today, the the Dow at 9.3% per year for the next 27 years would hit 500,000 points. which is absolutely insane. Now, some of us may not be around to see that. A lot of us hopefully will be, but that's an incredible, incredible number. That's what the bears have doubted. The Dow is at 47,000 points today, a number that nobody thought was possible. In the 80s, the Dow was hovering between 700 and 1,000 points for a few years. We just couldn't get past 1,000. And so back then, when we said, the Dow could get to 10,000, that was a crazy idea, and 20,000 was crazy, and 30,000 was crazy. When we said 40,000, people thought it was crazy. Well, we think long run, the Dow will hit 500,000. That's in my presentation from Investor Day. Make sure you go watch it and watch the other presentations that we'll publish on YouTube. Now, let's get into the content of this week's show. Yes, the S&P is at 6,700. We nailed the price target this year. We'll see what happens. Maybe market keeps going up a little bit for this year. I think if we hit 7,000 on the S&P, then we're probably just a touch overvalued. You're going to see a correction off of that, but typical correction is 5 to 10%. So if you see a 5% pullback off of 7,000 points, you're essentially buying the S&P in the 6,600 range, maybe 6,500. I put out a note a couple weeks ago to our clients. I think maybe you could see 6,400 temporarily if we have a 10% pullback, for example. So if all of these things happen, you could sit here and try and read the tea leaves and time the market and try and get in and get out and say, oh, Nick said 6,400 is the buying opportunity. Well, no, I'm saying that any point in time here is a buying opportunity depending on your time horizon. Now, if you're going to send your kids to college in 2 or 3 years and you need that money 2 years from now, 18 months from now, you shouldn't be in the market. You should be in a money market fund, something safe and liquid. And that's what we've done for our clients. If you have money coming up for expenses the next 2-3 years for retirement, for example, keep that money safe and secure. Don't risk the safe money that's goals based in the plan. But for your long range equity money, and I'm talking 5+ years of time horizon, even 3+ years of time horizon in a lot of cases, I think you should be in markets, and you should be in markets that are going to beat inflation, where the most technology, the most innovation has been. Where has it all happened? It's all happened right here in the U.S. And so, yes, money supply has compounded about 4.5 to 5, maybe even some years 5.5%, like it has been during the COVID years, since we printed 45, 50% more dollars in the economy. M2 money supply has gone up 4.5 to 5.5%. Well, inflation, CPI, has gone up about 3%. Why is there a difference between M2 and CPI? Yes, they are correlated, meaning M2 goes up, CPI inflation goes up. Why are they correlated but not 100% correlated? Well, the reality is that technology explains that delta. The innovation that entrepreneurs have done and the technology they've created by reducing input costs and by reducing how many resources we have to use to do certain things explains the delta between M2 and CPI. So why is it that equities beat inflation over the long run? Why is it that equities beat M2 money supply growth? Because of technology. So you should have a slight bent. This is what we say at Stenger Family Office. You should have a slight bent towards technology. Now, you have to be careful what you pay for tech, because some technology is overvalued, and the expectation that it's going to deliver all these big-time results in the short run is probably overhyped in some cases, but a lot of technology is not overvalued, and that's why we like to have about a 60% tilt towards growth and about a 40% tilt towards value. So not all or nothing, not all growth in the portfolio. That can really hurt you in the short run, but not all value either, because all value could hurt you in the long run. You don't have enough companies that are beating inflation. And so that's why we like to have that mix. Now, because the S&P is at 6,700, because the Dow is now at 47,000 points, a lot of people are referring to the current environment as a bubble, as a Fugazi Wazi. Now, we had somebody on the YouTube channel who left a comment and said, hey, the only reason markets are up is because of the Fed, because the Fed has printed money. And I adamantly disagree with all of these statements. I disagree with the fact that the only reason the market's up is because the Fed has printed money. I disagree with the fact that we are in a Fugazi-Wazi economy and environment. I adamantly disagree that this market is built on a fantasy. In fact, I'm going to show you on a few charts here in a second why that's false. But most importantly, just to say, there are pockets of this market that look bubbly. There are parts of the market that are absolutely overvalued. But that's been true in every market. In fact, we had the big plug power boom, the solar panel boom a few years ago. You remember that? Solar panel companies were overvalued. That did not mean the S&P as a whole was overvalued. We had the 1999 tech bubble. The S&P traded at 44 times earnings. Tech companies were radically overvalued. But companies like ExxonMobil, Procter & Gamble, Sherwin-Williams, continued to go up during the 2000s. We didn't have a lost decade in a lot of those value and dividend-paying companies. So no, the entire market today is not in a bubble, but parts of the market are. That doesn't mean you should be completely scared of the entire market, because we are going to trade the S&P today right around 24 times earnings current, and then on a forward basis, we're going to trade anywhere between 21 and 22 times forward earnings. That is not radically different than where we traded it, which I'll show you, all the way back to 1960. So I disagree with this idea that we are in this radically overvalued market environment where the only reason that stocks have gone up is because of M2 money supply. Now, if that were true, if it was true that the only reason stocks were up is because the Fed has printed money, that would mean every single company on Wall Street would be trading at record all-time highs. Kraft Heinz has completely bungled things. They've goofed up their entire business model. It's probably the worst merger that's ever happened of all time, and they're going to try and unwind that merger, probably go private and all this other stuff, and you can't look at Kraft Heinz today and say, oh, yeah, Kraft Heinz, M2 money supply went up, so Kraft Heinz should be up. That's not true. They ran a bad business. Their stock is down. Walgreens ran a bad business. I hate to say it. We love Walgreens. Darling of Wall Street in the 80s and 90s. We've got the truck right here. Have a lot of clients from Walgreens. But Walgreens management the past 10, 15 years is completely goofed up. So if M2 money supply is the only reason stocks go up, Walgreens should be at brand new record all-time highs today. That's not the case, because companies are actual operating entities. Companies, management teams drive business outcomes. And if you don't keep up, you don't innovate, you don't change your business mix over time, eventually what happens is you go out of business. You don't take care of your customers, your clients, you go out of business. So it's not because of M2 money supply that companies are up, and it's not because of M2 money supply that the bad companies are going out of business. It's simply because companies either innovate and they grow, or they don't innovate and they die. That's the reality of the market. Now, let me show you the most talked about company on Wall Street. Producer Katie. We have producer Katie here in the seat. Katie the Greek. Producer O's taking a little break on the show this week. Katie, if you don't mind pulling up this first slide. NVIDIA, this is NVIDIA's revenue on a quarterly basis going to the most recent quarter, which they call Q2 2026, which is actually right now, doing almost $47 billion a quarter in revenue at a 72, almost 73% gross margin. If you go back to last year at this time, they did $30 billion, and if you go back a couple years even before that, they were doing much less. Look at NVIDIA here the past couple years. I showed this chart to our clients at Investor Day. Today they do $86 billion with a B, $86 billion of earnings. In 2022, they did less than $10 billion, if you can believe that. You go back to 2018, NVIDIA did $3 billion in earnings. So I ask you the question, is NVIDIA in a bubble? Is NVIDIA a woozy-wazy stock? Absolutely not. In fact, NVIDIA today, you look at those PE ratios, NVIDIA today trades about 38 times earnings. In 2018, it traded for 52. NVIDIA, after all this growth, after all this run-up in its stock price, over 1,000% growth in its stock price, is still cheaper today than it was in 2018. I'm not telling you to go put everything in NVIDIA. I'm not telling you to take out a second mortgage on your house and bet the farm. I'm not saying any of that. I'm not saying to do anything with NVIDIA. I'm just giving you an example that people who say this stock is in a bubble are just wrong. They're not correct. It's bad information, and they're trying to just get clicks. Now, let's talk about another stock. This is on the growth side of the portfolio, CrowdStrike, doing $1.56 billion a quarter in annualized reoccurring revenue, which puts them now at $6.24 billion, a 40% year-over-year increase in ARR. So if you look at CrowdStrike today, it's a pricey stock, no question about it. I'm not going to say it's not. I've covered this on previous shows. But CrowdStrike is not a Fugazi-Wazi company. They have real earnings, real revenue. And by the way, total addressable market, they say is $250 billion. There's really 3 to 4 major players. I think they're going to get a significantly higher portion of that TAM than they have today. I think that revenue number could really get pushed into the $15 to $20 billion annualized range. So what does that tell you about CrowdStrike? Not a Fugazi-Wazi company. Now, does that mean you're not going to see a correction? You're not going to see a downturn? Absolutely not. You're going to see corrections in these companies, especially the higher the PE, the harder they fall during a correction. And I want to give you an example today of Netflix. Netflix is down about 8-9% in the market, and they're saying they missed a little bit on earnings, a little bit on revenue. Okay, well, if you remember back to just a couple years ago, 2021, going into 2022, Netflix, if you can believe it, was down 72%, their stock. And a lot of people said that was the end for Netflix. There's no way they're going to win the streaming war. There's no way they're going to be able to keep up with all the content creation you have to do and all the billions of dollars to spend. Well, it turns out they did. Netflix rallied from that low, and it's back basically to a record all-time high up until yesterday. So just be careful before you panic over stock as well over a short-term decline in its stock price. You could see this with a company like CrowdStrike. You could see this with a company like NVIDIA. In fact, NVIDIA over the past couple years has been down 50% 3 times. 50%. Those are big drawdowns. That's why we get paid to have a job. We tell you don't panic out of those companies. Now, another company defies the logic, another chart here, Katie, if you don't mind. It defies the logic of the Fugazi Wazi narrative is a company called Casey's, not necessarily a growth stock, not necessarily a technology AI company. Casey's General Stores, which literally is gas stations, they're selling you Cheetos and Zins and all the other stuff you get at the gas station. Okay, Casey's General Stores basically at a record all-time high in their stock price at 2,900 stores. Now, if you said, Nick, markets Fugazi Wazi, the only reason Casey's is up is because the Fed's printed money, I'd say you're absolutely insane. You don't know what you're talking about because Casey's only had 1,531 stores in 2010, and today they have 2,900 stores. Is that a Fugazi Wazi? Is that fake? Is that built on money printing? No, that is built on Casey's running a better gas station than other competitors. So you can't sit here and say that the whole market's based on the Fed just printing money. Yes, the Fed's printing money. That is true. But it's also true the fact that companies are running their businesses. And if you run your business better than the competition, you go from 1,500 stores to 2,900. It's no different than Sprouts Farmers Markets. It's no different than Costco. It's no different than any of these places. Another example we'll look at in just a few seconds is Sherwin-Williams, who's also grown store count. It's no different than a Sherwin-Williams. Now, let's talk about another value-oriented company. This is J.P. Morgan. Again, not a Fugazi Wazi, not just because the Fed has printed money. We look at here, this is reported in their Investor Day presentation, and they talk about wallet share. They talk about share of deposits in the U.S. Look at their market share of U.S. retail deposits. In 2014, they had less than 8%. They today have 11.3%. Credit card, they've grown market share. Investment assets, they've grown from $213 billion about a decade ago to $1.1 trillion today, up 5.1 times. Across the board, if you look at client assets, JP Morgan has gone from $2.3 trillion to $5.9 trillion in a decade. Here's another slide. This is what bankers refer to as tangible book value per share. Look at their growth since 2005, up 10% per year, twice that of their peers. Their peers are going to be a Bank of America, for example, maybe a U.S. bank. Up double compound annual growth rate on tangible book value. So if you want to sit there and say the only reason the market's up is because the Fed printed money, you're wrong. You're not looking at the data. You're not looking at the math and statistics. That's why we tell you, forget the narrative, look at the data. This is real. This is actual results. Now, let's go to Sherwin-Williams, which I mentioned a second ago. This doesn't go back that far. This only goes back to 2019. But this takes out the COVID boom. And I think that's really important because during COVID, everybody was sitting at home, looking at their houses, sitting inside saying, oh man, we got to do some work here. We got to do some painting, got to do some remodel. Okay, fine. So you could have dismissed the COVID boom. And you said, what is Sherwin-Williams doing now since 2019? Did they just live off the fantasy of COVID and money printing the past 4 or 5 years? Absolutely not. They do $23.1 billion in sales. They only did $18 billion in 2019. Adjusted earnings per share, 5-year compounded growth rate is 10% per year, not including dividend and buybacks. So let me take you back to 1985. Sherwin-Williams now, since 1985, is literally up 37,000%. if you can believe that. So if you say, Nick, it's all about money printing, it's all about Fugazi Wazi, it's just fake, it's built on a fantasy, then how come Sherwin-Williams is up 37,000%? Not every company since 1985 is up that much. In fact, Sherwin-Williams is one of the best all-time performers ever. Why is it that they're up that much? It's because they run a good company. It's that simple. People may not like to hear that, but that's just the reality of the stock market. If you run a good company, your stock goes up. Now, let's look at the general S&P 500 here. This is, I think, my last slide for you today. If we go back to 1960, the S&P only did $3.35 in earnings at a 22 price-to-earnings ratio. This year in 2025, analysts expect that we do $270 in earnings per share of the S&P at a 24 PE. Do you think people in 1960 sat there at 22 PE and said the market's radically overvalued? Because if they did, if they sat there at 22 PE saying the market's radically overvalued, guess what? They would have missed out on the best bull market, structural bull market of all time. And by the way, I think if we go into 2027, and I gave my outlook for Investor Day, what I think S&P is going to be at next year, I'll give it to you today. I think that earnings number is going to be closer to $340. It could even be higher, but let's just say $340. That's the analyst estimate today, analyst surveyed on Wall Street. I think we're going to multiply that $340 by around 22 times, which is actually going to be a lower PE than where we are today. And I think we're going to be at 7,480, almost 7,500 points on the S&P by the end of 2026. So that's the long-term vision of the stock market. That's the long-term vision of investing. Companies do well. Some companies don't do well. And there's a rotation through sectors. Sometimes healthcare does well. Sometimes technology. Sometimes financial. Sometimes consumer discretionary. There's a rotation that happens. And over the long run, companies that produce good results for their customers see their stock price go up. There was a phenomenal interview that was done with Jeff Bezos. I think it was in the 90s, maybe early 2000s. And they interviewed him, and they were kind of making fun of him. They said, Jeff, you have no earnings, you have barely any revenue, you're basically an online bookstore. Would you consider yourself an internet company, or what do you consider yourself? He goes, internet schminternet. That's a direct quote. He says, I don't care what kind of a company we're referred to by Wall Street. He goes, we just want to be one thing, and that's customer obsessed. We want to be obsessed over our customer. We want to hire people who are obsessed about the customer. And because they've been obsessed about the customer at Amazon, look at Amazon the past 30, 40 years now. I mean, Amazon is absolutely ripped. I shouldn't say 40, more like 30 years. But Amazon has seen its stock price and its business model just absolutely soar. Is that built on a fantasy? No. Amazon delivers a wonderful product, a wonderful service. So that's why the stock market goes up. Don't believe into this. Don't buy into this narrative. Don't believe this lie that the market is built on a fantasy. It's not. Yes, there's companies that are in a bubble. No question about it. But that's been true of every market, every environment. The general market, in my opinion, is going to go higher. Yes, we're going to have a correction. You're going to see it. If we hit 7,000 too soon and the earnings don't support it, you're going to see a 5 to 10% pullback. Don't be surprised by this. Don't be alarmed by this. You're going to remember that I told you this on the show today. But over the long run, you're going to see the market go up as earnings go up. Thank you for being with us. We're going to see you next week for episode 205. We'll see you at Masters there in Houston next week on the 28th. Can't wait to see you. Thank you for being with us. We'll see you next time.